The announcement came without warning. In a move that sent shockwaves through global commodity markets, China declared it would immediately halt all iron ore purchases from BHP, one of the world's largest mining corporations. What made this decision even more dramatic was the scope. Even shipments already at sea, cargo vessels laden with millions of tons of ore crossing the Indian Ocean toward Chinese ports, now faced the very real possibility of being turned away upon arrival. But China didn't slam the door completely shut. Instead, it left it slightly ajar, offering a single condition that could change everything. If BHP agrees to settle all iron ore transactions in Chinese yuan, rather than US dollars, trade could resume. On the surface, this might seem like a simple currency preference. In reality, it represents something far more significant, a direct challenge to the architecture of global trade itself. For BHP, the stakes couldn't be higher. China isn't just another customer, it's the customer. Losing access to this market could cost the mining giant upward of $30 billion annually. For Australia, where iron ore exports form the backbone of economic prosperity, the implications ripple far beyond corporate balance sheets, threatening jobs, government revenues, and the nation's fiscal stability. So what drove China to take such a bold, calculated step? Will Australia bend to Beijing's demands? And what does this confrontation reveal about the shifting power dynamics in the global economy? To understand where we are, we first need to understand how we got here. The geography of iron. Why Australia dominates. Iron ore is the lifeblood of modern civilization. From the steel beams holding up skyscrapers to the reinforcement bars in bridges, from automobiles to appliances, iron is everywhere. And when it comes to this critical resource, Australia sits atop a geological treasure trove that few nations can rival. With reserves estimated at 51 billion tons, Australia controls roughly 28% of the world's known iron ore deposits. But quantity alone doesn't tell the full story. What makes Australian iron ore particularly valuable is its quality. The ore extracted from Australian mines typically grades at 60% iron content or higher, meaning that more than half of every ton pulled from the ground is pure, usable iron. The crown jewel of Australia's iron ore industry lies in the Pilbara region of Western Australia, specifically within the Hamersley Basin. This remote, rust-colored landscape, stretching across thousands of square kilometers, hosts some of the richest iron deposits on Earth. Here, mining operations run 24 hours a day, with massive trucks hauling ore from open pits to processing facilities, before it's transported by rail to coastal ports for export. This region is home to the operations of global mining titans Rio Tinto and BHP Billiton. These companies don't just mine iron ore, they control vast integrated supply chains, from extraction to transportation to shipping. Their influence on global iron ore prices is immense, and their largest customer, by an overwhelming margin, is China. The numbers paint a clear picture. Approximately 83% of Australia's iron ore exports flow to China each year. In monetary terms, that translates to roughly $79 billion worth of ore crossing borders annually. This single commodity accounts for about 65% of total trade between Australia and China, making it the cornerstone of one of the world's most consequential economic relationships. For Australia, this dependence creates both opportunity and vulnerability. The iron ore boom has funded infrastructure, social programs, and contributed significantly to national prosperity. But it has also left the country exposed to the decisions and demands of a single buyer. China's iron ore paradox: rich in reserves, poor in quality. Given China's status as a manufacturing powerhouse and the world's largest steel producer, you might reasonably wonder, why doesn't China simply mine its own iron ore? Why import hundreds of millions of tons from halfway around the world? The answer lies in geology and economics. China does have substantial iron ore reserves, In fact, it ranks among the top nations globally in terms of total deposits. But there's a critical difference between having iron ore and having economically viable iron ore. Most of China's domestic iron ore is what industry experts call low-grade. The average iron content in Chinese ore hovers around 33%. This means that for every ton of rock extracted from Chinese mines, only about 330 kilograms is actual iron. The rest is waste material that must be processed, transported, and disposed of, all of which adds cost and complexity. Compare that to Australian ore at 60% grade, and the efficiency gap becomes stark. Australian ore contains nearly twice as much iron per ton, which means less material needs to be moved, less processing is required, and transportation costs are proportionally lower per unit of usable iron. There's another challenge with China's domestic iron deposits: distribution. Rather than being concentrated in a few large, easily accessible locations like Australia's Pilbara region, Chinese iron ore is scattered across numerous small and medium-sized mines throughout the country. This fragmentation increases operational complexity and drives up costs. Mining in mountainous or remote regions adds further difficulty and expense. When you factor in labor costs, energy requirements for processing lower-grade ore, and the environmental impact of extensive mining operations, the economics become clear. Importing high-quality iron ore from Australia has historically been more cost-effective than relying solely on domestic production. But this economic logic has come with a price, not just in dollars, but in strategic vulnerability. China's dependence on Australian iron ore has, at times, left it exposed to price manipulation and geopolitical pressure. And as we'll see, that vulnerability eventually prompted Beijing to take action. The price war, when iron ore became a weapon. For years, the relationship between China and Australia's mining sector followed a predictable pattern. China bought enormous quantities of iron ore. Australian miners profited handsomely, and both sides benefited from the arrangement. But beneath this surface cooperation, tensions were building. BHP, along with other major miners, enjoyed what economists call pricing power. When you control a large share of a critical resource and your customer has limited alternatives, you can effectively set prices, and BHP exercised that power aggressively. Industry insiders estimate that it costs BHP approximately $20 to extract and process a single ton of iron ore. Yet the price at which that ore was sold to Chinese buyers often reached several times that amount. During peak periods, the profit margins were extraordinary, a testament to BHP's market dominance, but also a source of growing resentment in Beijing. The situation escalated dramatically in 2018. That year marked the beginning of the US-China trade conflict, and Australia found itself choosing sides. Then Prime Minister Scott Morrison aligned Australia firmly with Washington, supporting American efforts to contain China's economic and strategic influence. This political positioning had direct economic consequences. Australian iron ore prices, which had been elevated but relatively stable, suddenly began to spike. The Platts Iron Ore Price Index, a key benchmark for the industry, surged from $70 per ton to an astonishing $220 per ton. This wasn't simply market dynamics at work. There was a clear element of leverage being applied. From Beijing's perspective, the message was unmistakable. Australia was using its control over iron ore supplies, not just as a business strategy, but as a geopolitical tool. China, despite being the customer with the deepest pockets and the most consistent demand, found itself in a position of weakness, forced to pay inflated prices for a resource essential to its industrial base. This situation was unsustainable, and Chinese policymakers knew it. They began developing a long-term strategy to reduce dependence on Australian iron ore, and more importantly, to break the pricing power that miners like BHP had wielded so effectively. China's strategic response: diversification and leverage. Between 2018 and 2022, China embarked on an aggressive campaign to reduce its reliance on Australian iron ore. The results were striking. China's dependence on Australian supplies plummeted from 87% to just 40% in that 4-year period. How did China achieve this? Well, through a methodical strategy of diversifying import sources. Brazilian mining giant Vale became an increasingly important partner. African mines, particularly in countries like Guinea and Sierra Leone, received Chinese investment and technical support. Smaller suppliers in India and elsewhere also saw increased Chinese interest. This wasn't just about finding alternative sources. It was about fundamentally restructuring the market dynamics. By demonstrating that it could source iron ore from multiple suppliers, China weakened the pricing power of any single producer. The implicit message to Australian miners was clear: you are replaceable. The political landscape in Australia shifted in 2022 when the Labour Party, led by Anthony Albanese, came to power. Unlike his predecessor, Albanese moved quickly to stabilize relations with China. Trade restrictions on both sides began to ease. Diplomatic communication channels, which had been frozen, reopened. For the iron ore industry, this thaw brought relief. Trade volumes began recovering, and by 2024, bilateral commerce between China and Australia had essentially returned to levels last seen in 2017. Mining executives and government officials in Canberra breathed easier, believing the worst had passed. That sense of security, however, was premature. What appeared to be a return to normalcy was, in fact, a temporary pause before an even more consequential confrontation. September 2025, the Yuan Ultimatum. On September 30th, 2025, China dropped a bombshell. In an official announcement that caught markets, analysts, and the Australian government off guard, Beijing declared an immediate suspension of all iron ore purchases from BHP. The terms were unambiguous. Going forward, any iron ore exported from Australia to China must be settled in renminbi, the Chinese yuan. No exceptions would be made, not even for shipments already in transit. To understand why this matters, we need to look beyond the surface-level issue of currency preference. For decades, the US dollar has been the dominant currency in global commodity trading. Oil, natural gas, metals, agricultural products, virtually every major commodity is priced and traded in dollars. This arrangement, often called the petrodollar system in the context of oil, gives the United States enormous economic and geopolitical leverage. When countries need to buy commodities, they must first acquire dollars. This creates constant demand for U.S. currency, which in turn allows the American government to run large deficits, borrow cheaply, and exert financial pressure through sanctions. Any nation that steps outside this dollar-denominated system risks being cut off from global financial infrastructure. China's demand for yuan settlement is therefore about much more than convenience. It's a direct challenge to dollar hegemony. If successful, it would mark a significant step toward a multipolar global financial system where the yuan stands as a viable alternative to the dollar for international trade. For China, there's also a practical advantage. When transactions are conducted in yuan, Chinese companies avoid currency exchange costs and foreign exchange risks. More importantly, using their own currency gives Chinese buyers greater control over the transaction process and reduces exposure to U.S. financial sanctions. But perhaps the most significant aspect of this move is what it reveals about negotiating leverage. For years, China was the party with the demand, but not the power. Now, by threatening to cut off access to the world's largest iron ore market, China has flipped the script. Suddenly, it's the miners who need to accommodate Beijing's terms. The timing of this announcement was no accident. China made this move from a position of strength, having spent years building alternative supply chains and reducing its vulnerability to any single source. The question now is whether BHP and the Australian government will accept the new reality. The economic impact. Australia's $30 billion question. For BHP, the financial implications of China's decision are severe. In 2024 alone, the company exported approximately 250 million tons of iron ore to China, representing sales worth more than $30 billion US. Roughly 60% of BHP's total revenue comes from the Chinese market, making it not just the company's largest customer, but the foundation of its entire business model. When news of the suspension broke, financial markets reacted immediately. BHP's stock price fell between 3.4% and 4% in a single trading session. The company's market capitalization dropped by nearly $39 billion. While stock prices are volatile and can recover, the message was clear. Investors understood the existential threat this posed. If China maintains its ban and BHP refuses to accept Yuan settlement, the company faces annual losses of at least $30 billion. That's not a hypothetical scenario. It's a direct calculation based on current trade volumes. Such a revenue shock would force dramatic restructuring, from workforce reductions to mine closures to dividend cuts that would affect pension funds and retirement accounts globally. But the impact extends far beyond BHP's corporate headquarters. Western Australia, the state where most iron ore mining occurs, derives approximately 40% of its government revenue from taxes and royalties on iron ore exports. These funds pay for schools, hospitals, roads, and public services. If iron ore exports to China are severely disrupted, the state government's projected budget deficit could balloon to $16.4 billion. Employment effects would be widespread and devastating. Australia's mining industry directly employs about 150,000 workers. These are typically well-paying jobs that support families and communities, particularly in regional areas where alternative employment options are limited. Beyond direct employment, the mining sector supports an estimated 500,000 additional jobs in logistics, maintenance, equipment manufacturing, and services. If iron ore exports freeze for an extended period, large-scale unemployment becomes almost inevitable. The economic shock would ripple through entire towns built around mining operations, potentially triggering a social crisis with long-term consequences. Australian political leaders find themselves caught between economic necessity and strategic alliance commitments. Accepting Yuan settlement would stabilize iron ore trade and protect jobs, but it would also represent a symbolic break from the dollar-based system that the United States has championed. For a country that has positioned itself as America's closest Asia-Pacific ally, that's not a decision to be made lightly. Rio Tinto's pragmatic choice. A preview of things to come. While BHP hesitates, Rio Tinto, Australia's other mining giant, has already made its decision. The company announced it would accept yuan-denominated transactions for iron ore sales to China. For Rio Tinto's leadership, the calculation was straightforward. Maintaining access to the Chinese market was worth adapting to Beijing's payment preferences. This pragmatic approach reflects Rio Tinto's assessment of market realities. With China accounting for such a large share of global iron ore demand, the company concluded that currency flexibility was a small price to pay for commercial continuity. So why hasn't BHP followed suit? The answer likely lies in ownership structure and geopolitical considerations. Nearly half of BHP's shares are held by American institutional investors, pension funds, investment firms, and other entities closely aligned with U.S. financial interests. These shareholders exert considerable influence over major corporate decisions. From Washington's perspective, accepting Yuan settlement for large-scale commodity transactions isn't merely a business matter. It's a strategic retreat. Every barrel of oil, every ton of iron ore, every shipment of soybeans that shifts from dollar to yuan settlement chips away at the financial architecture that has underpinned American global power since World War II. Australian policymakers understand this dynamic. As a member of security arrangements like AUKUS and the Quad, Australia has positioned itself as a key partner in American efforts to manage China's rise. Accepting yuan settlement for its most valuable export would send a signal that could strain those relationships. Yet the economic pressure is immense and mounting. Australia now faces a genuine dilemma: defend the dollar system and risk economic pain, or prioritize commercial interests and accept a diminished role for the dollar in its trade relationships. There's no easy answer, and the choice Australia makes will reverberate across the global economy. China's ace in the whole Vale and the Brazilian connection. One reason China can afford to play hardball with Australian miners is that it has cultivated strong alternatives. Chief among these is Vale, the Brazilian mining conglomerate that ranks as one of the world's largest iron ore producers. Vale's relationship with China dates back decades, but it has intensified significantly in recent years. By 2014, more than half of Vale's iron ore production was being sold to Chinese buyers. The company's operations in Brazil's Iron Quadrangle region, along with newer projects in the Carajás mining complex in the Amazon, produce more than 300 million tons of iron ore annually, with a commercial value exceeding $30 billion. In 2024, Vale exported 328 million tons of iron ore to China, roughly 100% of its total production capacity dedicated to serving Chinese demand. This deep commercial relationship has given both sides strong incentives to maintain cooperation. Crucially, Vale has publicly confirmed that it will not raise prices for Chinese customers and has agreed to conduct transactions in yuan. This decision aligns perfectly with Beijing's current strategic objectives. By securing a major supplier willing to work within a yuan-based framework, China demonstrates that its currency ultimatum isn't a bluff. It has viable alternatives ready to step in if Australian miners refuse to adapt. The Vale partnership also reduces China's vulnerability to supply disruptions, unlike the Australia-China route, which can be affected by regional geopolitical tensions or disruptions in critical shipping lanes like the Strait of Malacca. Brazilian iron ore travels across the Atlantic, providing route diversification. For Vale, the calculation is equally clear. With Chinese demand representing such a massive share of its market, alienating Beijing would be commercial suicide. The company has chosen pragmatism over any potential concerns about currency politics, and that choice has been rewarded with continued access to the world's most important iron ore market. The Guinea Gambit, China's long-term strategic investment. While Brazil provides a crucial current alternative to Australian iron ore, China has been looking even further ahead, making massive investments in African mining projects that could fundamentally reshape global iron ore supply chains. The most significant of these projects is the Simandou iron ore mine in Guinea, located in the remote southeastern region of this West African nation. Simandou isn't just another mining project. It's one of the largest and highest-grade undeveloped iron ore deposits anywhere on Earth. The numbers are staggering. Proven reserves at Simandou exceed 5 billion tons, with iron grades typically above 65%. That grade matches or exceeds the best Australian ore, meaning Chinese steel mills would lose no quality advantage by sourcing from Africa rather than Australia. China's commitment to this project has been profound. Total Chinese investment in Simandou has surpassed $20 billion, covering not just mine development but also extensive infrastructure. Chinese companies, including Chinalco and Baowu Steel, have led the construction of railways to transport ore from the inland mine to coastal ports, built port facilities capable of handling massive ore carriers, and established the full supply chain necessary to bring this resource to market. After years of development and political challenges, Guinea has experienced coups and instability that delayed progress. Simandou is finally approaching operational status. Current projections indicate that the mine will begin production by the end of 2025, with initial output capacity of 120 million tons annually. Long-term development plans envision production reaching 175 million tons per year. The symbolic and practical importance of Simandou cannot be overstated. In October 2025, the first cargo vessel loaded with Simandou ore is scheduled to arrive in China, marking the official launch of this strategic resource into global supply chains. Once Simandou reaches full production capacity, China's dependence on Australian iron ore will decline significantly. Combined with supplies from Brazil, African sources, and smaller producers elsewhere, China will have successfully diversified its iron ore imports to a point where no single country can exercise the kind of pricing power that Australia once enjoyed. This is the context that makes China's ultimatum to BHP so significant. Beijing isn't negotiating from a position of desperation or vulnerability. It's negotiating from strength, backed by alternative sources that are either already flowing or about to come online. For Australian miners and policymakers, this represents a fundamental shift in the balance of power. The currency war behind the iron ore war. To fully understand what's happening between China and Australia, we need to zoom out and see this conflict as part of a much larger transformation in the global financial system. For nearly 80 years, the US dollar has been the world's reserve currency. This status emerged from the Bretton Woods Agreement of 1944, which pegged international currencies to the dollar, and was later reinforced when the dollar became the primary currency for oil trading in the 1970s.